Right now, something very unusual is happening in the silver market, something that experienced commodities traders immediately recognize as a warning sign. Over the last several weeks, the global silver market has begun showing clear signs of stress. Futures prices are moving erratically, exchange inventories are quietly shrinking, and physical silver buyers across multiple regions are reporting delays, higher premiums, and tightening supply. For years, the silver market has operated on a system where paper contracts, not physical metal, dominate price discovery. On exchanges like COMEX, massive volumes of silver futures are traded every day, often representing hundreds of times more silver than actually exists in exchange warehouses. Under normal conditions, this structure works because most traders never request physical delivery. Contracts are closed, rolled forward, or settled in cash. But when physical demand suddenly rises, that system begins to strain, and that appears to be exactly what we are seeing right now. Demand for physical silver coins and bars is rising across major markets, particularly in Asia and North America, while the amount of registered silver available for delivery inside key exchanges has been declining. The result is a growing divergence between the paper market and the physical market. Futures prices suggest one reality, but the physical supply chain is telling a very different story. Historically, when this kind of divergence appears, it signals a deeper structural imbalance forming beneath the surface of the market. Investors often ignore these signals early because the price chart does not immediately reflect the pressure building inside the system. But once that imbalance reaches a certain point, the market can adjust very quickly. That is why analysts and institutional traders are now watching the silver market much more closely. Because if physical demand continues rising, while available supply continues falling, the silver market could be approaching a moment where the traditional pricing structure begins to break down. At first glance, a disruption in the silver market might seem like a niche issue affecting only commodity traders or precious metals investors. But the reality is far more significant. Silver is one of the most important industrial metals in the modern global economy. It is used in electronics, solar panels, medical technology, batteries, and countless advanced manufacturing processes. In fact, silver plays a critical role in the global transition toward renewable energy. Solar panels alone consume enormous quantities of silver every year, and demand from that sector continues to grow rapidly as governments push for cleaner energy infrastructure. At the same time, silver also functions as a monetary metal. For centuries, it has served as a store of value during periods of economic uncertainty, inflation, or currency instability. This dual role makes silver extremely sensitive to both industrial demand and financial market dynamics. When the silver market becomes unstable, the effects can ripple far beyond the precious metals sector. Manufacturers may face rising costs if silver supply tightens. Investors may begin shifting capital into hard assets if confidence in currencies weakens. And financial markets can experience increased volatility as traders react to sudden price movements. In other words, silver sits at the intersection of two powerful forces: global industrial demand and global financial uncertainty. That is why structural disruptions in the silver market often attract attention from central banks, hedge funds, and major institutional investors. When a market this important begins showing signs of imbalance, it raises broader questions about supply chains, inflation pressures, and the stability of financial markets. For ordinary investors, understanding what is happening in silver can provide insight into larger economic trends, because historically, movements in precious metals have often signaled deeper shifts in the global financial system. The current tension in the silver market did not appear overnight. It has been building quietly for months, but recently several developments pushed the situation into the spotlight. First, exchange inventory data began showing a steady decline in registered silver holdings. Registered silver refers to the metal that is actually available for delivery against futures contracts. When these inventories drop, it means there is less physical metal backing the massive volume of paper contracts traded on the exchange. At the same time, demand for physical silver products surged. Bullion dealers across multiple countries reported increased buying activity from both retail investors and institutional clients. In some regions, popular silver coins and bars temporarily went out of stock, forcing dealers to raise premiums significantly above the official spot price. Meanwhile, Futures market volatility increased. Silver prices experienced sharp intraday swings, sometimes moving several percentage points within hours. This kind of price behavior often indicates aggressive trading activity or growing uncertainty among large market participants. Another important signal came from the widening gap between futures prices and physical premiums. In a normally functioning market, the difference between these two prices remains relatively small. But recently, physical buyers have been paying noticeably higher prices than the futures market suggests. That divergence indicates that real-world supply and demand may be tightening faster than the paper market is reflecting. When these signals appear together, falling exchange inventories, rising physical premiums, and increasing futures volatility, they often point to stress inside the market structure. And that is exactly why analysts are now asking a critical question. Is the silver market approaching a point where physical demand begins to overpower the paper trading system that normally controls price discovery? To understand the deeper cause behind this tension, it is necessary to examine how the silver market is structured. Unlike many physical commodities, the majority of silver trading does not involve actual metal changing hands. Instead, most transactions occur through derivatives, primarily futures contracts. These contracts allow traders to speculate on the price of silver without ever owning the physical metal. In fact, the daily volume of silver futures trading often represents hundreds of millions of ounces, even though only a fraction of that amount actually exists in exchange warehouses. This system works because most traders never intend to take delivery of the metal. They simply close their positions before the contract expires. As long as confidence in this system remains high, the futures market effectively determines the global silver price. But problems can arise when physical demand begins to rise sharply. If enough buyers start requesting actual delivery instead of cash settlement, the exchange must have sufficient metal available to fulfill those obligations. When inventories begin declining while demand increases, the margin for error becomes smaller. That is when market participants start paying closer attention to the relationship between paper contracts and physical supply. In recent months, this relationship appears to be tightening. Physical demand from both investors and industrial users has increased, while exchange inventories have not grown at the same pace. The result is a growing imbalance between the amount of silver being traded on paper and the amount actually available in storage. If that imbalance continues widening, it could eventually force the futures market to adjust prices in order to attract additional supply. When markets experience structural disruptions, the consequences rarely remain confined to trading floors or financial charts. The real impact often appears in the broader economy, affecting businesses, industries, and ultimately everyday people. Silver plays a critical role in multiple sectors that rely on stable supply chains. Electronics manufacturers depend on silver for circuit boards and micro-components. Renewable energy companies rely on it for solar panel production. Medical technology firms use silver in specialized equipment and antimicrobial applications. If silver supply becomes constrained or prices rise rapidly, these industries can face significant cost pressures. Manufacturers may be forced to absorb higher raw material costs or pass them on to consumers. Production delays can occur if companies struggle to secure sufficient supply. Smaller businesses with limited purchasing power may be hit the hardest, especially if they cannot compete with larger corporations for scarce resources. These disruptions can ripple through supply chains, affecting employment, pricing, and product availability. Historically, commodity shortages often trigger broader economic consequences. Rising input costs can contribute to inflation, while supply disruptions can slow industrial production. In extreme cases, entire industries may be forced to adjust their production strategies or search for alternative materials. For investors, these developments highlight the importance of understanding how commodity markets interact with the real economy. Precious metals are not just financial assets. They are essential components of modern infrastructure and technology. When markets like silver experience structural stress, the effects can eventually reach far beyond the commodity sector. One of the major forces amplifying the current silver market tension is global monetary policy. Over the past several years, central banks have dramatically expanded the money supply in response to economic crises and financial instability. Trillions of dollars have been injected into the global financial system through stimulus programs, asset purchases, and emergency lending facilities. While these policies were designed to stabilize economies, they also created long-term consequences. One of those consequences is persistent inflation pressure. As the purchasing power of currencies weakens, investors often begin seeking assets that historically hold value during inflationary periods. Precious metals like gold and silver have played that role for centuries. When inflation expectations rise, demand for these metals tends to increase as investors look for protection against currency depreciation. Recently, inflation concerns have re-emerged across multiple regions of the world. Energy prices remain volatile, government debt levels are extremely high, and interest rate policies remain uncertain. These conditions have encouraged many investors to reconsider the role of hard assets in their portfolios. Silver, in particular, attracts attention because it combines monetary characteristics with strong industrial demand. As more investors allocate capital toward precious metals, the pressure on physical supply can intensify. If investment demand continues increasing while industrial demand remains strong, the silver market could experience a significant shift in its supply-demand balance. Another factor intensifying the pressure on silver markets is the rapid growth of new industrial demand, particularly from the renewable energy sector. Over the past decade, global investment in solar energy has expanded dramatically. Governments and private companies are racing to build new solar infrastructure as part of broader climate and energy transition policies. Silver plays an essential role in photovoltaic technology, which is used to convert sunlight into electricity. Each solar panel requires small but significant quantities of silver in its conductive components. When multiplied across millions of panels, this demand becomes enormous. According to industry estimates, solar energy alone now consumes a substantial portion of the world's annual silver production. And as solar deployment continues accelerating, that demand is expected to grow even further. At the same time, silver mining production has struggled to keep pace. Many silver mines operate as secondary operations within larger mining projects, focused on other metals like copper, lead, or zinc. This means silver supply cannot always expand quickly in response to rising demand. When industrial demand increases faster than mining output, supply constraints can develop over time. These constraints may not immediately appear in futures prices, but they can gradually tighten physical markets. That tightening is one of the factors analysts believe may now be emerging. The implications of a tightening silver market extend beyond individual investors or industries. In some cases, commodity disruptions can influence national economic strategies and policy decisions. Countries with significant mining industries may benefit from rising commodity prices, while countries heavily dependent on imports may face increased costs. Silver's role in renewable energy also gives it geopolitical significance. Governments seeking to expand clean energy infrastructure must ensure reliable access to key raw materials. If silver supply becomes constrained, it could complicate long-term energy transition plans. In addition, precious metals markets often reflect broader shifts in global financial confidence. When investors increasingly turn to assets like silver or gold, it can signal growing uncertainty about currencies, debt levels, or monetary policy. For policymakers, these signals are closely watched indicators of market sentiment. In extreme cases, rapid movements in precious metals can trigger broader financial reactions, including shifts in capital flows and investment strategies. While the silver market alone may not determine global economic stability, it often serves as a valuable indicator of deeper structural forces operating within the financial system. The silver market today sits at a potentially important crossroads. On one side is the established paper trading system that has dominated price discovery for decades. On the other side is a growing wave of physical demand from investors and industries around the world. As long as these two forces remain balanced, the market can continue functioning normally. But if the gap between paper supply and physical availability continues widening, the system could eventually face a moment of adjustment. That adjustment might come in the form of higher prices, tighter supply conditions, or structural changes within the futures market itself. Historically, commodity markets often appear stable right up until the moment they suddenly shift. Small imbalances build quietly beneath the surface until they reach a tipping point. Whether the silver market is approaching such a moment remains uncertain, but the signals currently appearing, tightening inventories, rising physical premiums, and increasing volatility, suggest that the market deserves close attention. For investors and analysts alike, the most important approach is careful observation. Markets reward those who study data, understand structural dynamics, and remain patient during periods of uncertainty. Because in complex systems like global commodities markets, the most significant shifts often begin long before they become obvious to everyone else.